Welcome to this session of the London Financial Regulation Seminar. The first time, interdisciplinary group of experts, which is led by CCLS, Centre for Commercial Law Studies of Queen Mary University of London, and our Institute of Banking and Finance, and I'm the director, and Daniel de Alba is the deputy director. And today we have Professor Hilary Allen, who will be discussing one of her research papers, not her last, because since then she has continued to write, but one that she has presented in a number of circles, including the Federal Reserve Bank of New York and the Bank of England, and it's called DeFi, Decentralized Finance, Shadow Banking 2.0 ? And in this paper, which she will present, she will not be using slides, so that will allow for greater interaction. She will discuss how the context of sometimes what is called the illusion of decentralization, and here I'm quoting from a phrase that she has coined herself, and which actually has come to the fore with the recent collapse of FTX. I mean, only today in the Financial Times, it is reported that investors pull record holding from crypto exchanges. But in this paper, which she wrote time ago, when still a lot of the excitement about these, the opportunities of this new technology offers to financial services, she already expressed a number of reservations. And she said how, following the global financial crisis, it exposed the limitations of what she refers to as shadow banking 1.0, with securitization, the role of credit rating agencies, and a number of other shadow institutions that played a major role, and that since then have been more heavily regulated, or at least regulated to some extent, at least greater degree of transparency. And she claims that with decentralized finance, we may be witnessing shadow banking 2.0, and the regulatory response will be in the making, if that was the response, obviously, that was expected when it came to DeFi 1.0. But I'm not going to continue to talk about her paper, because it's a fantastic piece of research and one that has been already very influential. So I'll just say that a little bit about her background. She's a professor of law and associate dean for a scholarship at the American University of Washington College of Law, where she teaches banking, securities, and business association. And she is a recognized expert internationally in this field, and just generally in the field of financial technology. And she's presented her work in a number of central banking fora, as well as parliamentary committees in the US, like the House Financial Services Committee and the Senate Banking Committee. Among her many publications, her book, Driverless Finance, FinTech's Impact on Financial Stability, published by Oxford University Press, is already an authoritative reference in the subject. I'll also introduce now, briefly, my dear friend and colleague, Professor Emilios Aurkoleas, with whom I have been working for many years, if not decades. And he is he holds the International Banking Law and Finance Chair at the University of Edinburgh, and is also the founding director of the Edinburgh LLM in International Banking Law and Finance, and serves as a member of the European Securities and Markets Group, the stakeholder group of the ESMA, the European Securities and Markets Authority. And like Hilary, he's an expert on all matters related to financial technology, as well as the law of financial innovation more generally. He also is active in other areas of bank resolution, financial stability, and has got a very prestigious and distinguished scholarship to conduct research in this area. So without further ado, otherwise I will continue to talk about our two distinguished scholars, I will mute myself and I will give the floor to Hilary Allen. Thank you.
Well, thank you so much for inviting me, Rosa. I'm such a fan of your work over the years, and it's been very influential. So it was delightful to receive this invitation. And then I was doubly delighted that Emilios agreed to be the commenter on this paper, because I can't think of anyone more qualified, frankly, to speak on this paper. So I'm thrilled to be speaking here with you. Rosa mentioned that I have testified before the US Senate Banking Committee on fintech in the past, on crypto. I will be doing it again on Wednesday. So that's where my headspace is a little bit. I'm getting ready for that. I'm going to pull myself out of that and talk more about this paper, which, I mean, they're very much linked, because as Rosa mentioned, I wrote this paper, basically started writing it a year ago and put the first draft out in February of 2022. And that was before the so-called crypto winter. That was before the FTX collapse. And this was a time where people were very gung-ho about DeFi, and it was unusual for anyone to express reservations. And I received a lot of pushback, criticism, etc., from people in the crypto industry and just from crypto fans in general. So the tone, I guess, of the reception of this paper has changed with the intervening events, but I think the paper itself still holds up pretty well. So my presentation today is titled DeFi Shadow Banking 2.0 ? And there's a question mark because the fate of the DeFi ecosystem is not yet set in stone. My basic thesis in this paper is that DeFi, which stands for decentralized finance, is neither decentralized nor efficient, nor is it an effective way of promoting financial inclusion, and that with such limited benefits, regulators should clamp down on DeFi to prevent it from evolving into shadow banking 2.0. So if I'm talking about shadow banking 2.0, there must be a shadow banking 1.0. And in this paper, I use that term to describe the financial innovations that helped cause or exacerbate the financial crisis of 2008. In particular, I focus on credit default swaps, mortgage-backed securitizations, and money market mutual funds. And the key thing that I want to emphasize here about shadow banking 1.0 is that its evolution was not inevitable, but resulted from a series of policy choices, such as the SEC's decision to permit money market mutual funds to have special accounting rules that valued a share in a money market mutual fund at $1, even if the value of the underlying reserve assets fluctuated somewhat. Perhaps the most infamous of all of these policy decisions, though, was the passing of the Commodity Futures Modernization Act in 2000 that essentially forbade regulation of credit default swaps and other swaps. So these innovations were facilitated by policy decisions, by regulatory decisions. With each of these financial innovations, I briefly describe them, then talk about how they were able to threaten the stability of the financial system in 2008, the absence of needed regulation, and conclude with how regulatory reform after 2008 has addressed some of the financial stability risks, but has been unable to fully put the genie back in the bottle. So in terms of the financial stability risks associated with credit default swaps, I emphasize the ability of uncollateralized credit default swaps, particularly those issued by AIG, to multiply the amount of leverage in the financial system, making it more susceptible to booms and busts. When I talk about mortgage-backed securities, I talk about how their contractual rigidity prevented modifications of financial arrangements that would have created more flexibility around mortgages. And I also talk about valuation problems that arose when it wasn't clear how rigid contractual terms applied in an environment of uncertainty. I also talk about the spillover effects of runs on money market mutual funds. And then I think sort of the broader overarching theme is that I express a concern regarding unnecessary complexity. Financial regulators learned in 2008 something that complexity scientists have known for a long time. More complexity creates more fragility. So I see very clear analogs to these problems of complexity, leverage, rigidity, and runs in the DeFi ecosystem, if the DeFi ecosystem were allowed to grow to scale. So just by way of background, the working definition I'm using of DeFi is this. So DeFi describes any software application known as a DApp or a DApp that serves as a simulacrum of traditional financial services provided using tokens that are hosted on a permissionless distributed ledger, usually the Ethereum blockchain. Payments in DeFi are often made using a type of cryptocurrency known as a stablecoin that is pegged to the value of fiat currency. So these dApps are often built using smart contracts, which are usually integrated with more traditional forms of software to create user-facing interfaces. So I know I just threw a whole lot of technological terminology at you. I'm happy to expand or discuss any of those elements in the Q&A should people wish. So returning to DeFi's analogs to shadow banking 1.0, because tokens don't have to be tied to any real-world productive capacity, there is a potential for infinite synthesis. And without any legal requirements around capital, margin, or netting, people can borrow against that infinite supply of tokens in a way that ratchets up the amount of leverage in the system. Now, some DeFi lending platforms do require over-collateralization, but it's really hard to tell what counts as adequate over-collateralization when crypto asset prices are so volatile. And this over-collateralization is just a market practice that is not always observed. So-called flash loans, for example, can be huge and don't require any collateral at all. While counterparty credit risk is purportedly eliminated in these flash loans because the loans are repaid within the same block of transactions in which they're borrowed, further investigation is needed of the systemic impact of large bursts of leverage into the DeFi ecosystem. Turning to the smart contracts that DeFi relies upon, these are not really contracts. These are computer programs that are intended to be self-executing, and they take rigidity to a whole other level. We could see financial arrangements between parties executing automatically, even when the parties themselves, as well as the financial system as a whole, would benefit if execution were delayed or excused. Turning to money market mutual funds, some kinds of reserve-backed stablecoins share similarities with these funds in their promise to pay $1 per coin because of asset backing. And many people have already focused on stablecoins' susceptibility to runs. So I won't get into that here, but again, happy to talk about stablecoins and runs in the Q&A. So we see a lot of these fragilities mirrored in DeFi. To be clear, DeFi is not big enough or intertwined enough with our established financial system to pose a real threat to our economy yet. But when I wrote this paper a year ago, before the crypto winter, it was growing very fast. And I argued that we should be very wary of arguments that DeFi was too small to care. I argued that in the paper that we were at a pivotal moment, similar to the year 2000, when the decision was made to allow swaps to evolve unregulated. I argued that inaction was a policy choice tantamount to the enactment of the Commodity Futures Modernization Act. With the crypto winter, DeFi has lost some of its momentum. However, momentum for crypto legislation has sped up in Washington, and some of the legislative proposals, particularly legislation designed to bring stablecoins into the banking system, could legitimize and turbocharge DeFi again. I still stand by my arguments in this paper that regulators should instead act aggressively to clamp down on DeFi where they can, and most importantly, to wall off DeFi from banks and our established financial system more broadly. I want to deal now with the chief objection to this kind of precautionary approach that I'm advocating, and that is that it will prevent innovation. My starting point for such a discussion is that innovation is not inherently good. Innovations can be dangerous, or they can generate significant negative externalities for society, or they can simply be functional equivalents for what we already have that have innovated around the law. And in this latter case, we call them regulatory arbitrage. Sometimes innovations are all of the above. Public policy that stamps out bad innovation before the genie gets out of the bottle is good public policy. And we see that kind of policy in action with things like FDA regulation of pharmaceuticals. Financial regulators have historically been reluctant to be this precautionary, though, preferring to wait and see with new financial products. But that wait and see attitude was identified by the Financial Crisis Inquiry Commission as a significant contributing factor to the 2008 crisis. The economic and social costs of financial crises are enormous. Importantly, they are disproportionately borne by the most vulnerable members of society, often people who never invested in or acquired the financial products that caused the financial crisis. Still, on the flip side, there can obviously be costs to preventing innovation. So let's take a closer look at what we're at risk of losing if we clamp down on DeFi. As I mentioned at the outset, DeFi is not particularly decentralized, and it is also unlikely to improve efficiency or financial inclusion. Anything more than a cursory look at the DeFi ecosystem shows that it is rife with intermediaries. DeFi users rely on some combination of ISPs, core software developers, miners, wallets, exchanges, stablecoin issuers, oracles, providers of client APIs used to access distributed ledgers, concentrated owners of governance tokens in DAOs. The list goes on. And this proliferation of intermediaries is not surprising for both technological and economic reasons. Decentralized services simply don't scale very well. As a result, they tend to charge more and service fewer transactions. There's also sometimes a need for intermediaries to intervene when something unanticipated happens. And so there are profits to be made from centralizing things that are decentralized. Researchers from the Bank for International Settlements called this out in no uncertain terms, calling decentralization in DeFi an illusion. In short, DeFi doesn't so much disintermediate finance as replace trust in established banks with trust in new intermediaries who are often unidentified and unregulated. And there have been many examples of these new intermediaries engaging in outright scams or exercising their powers to reverse purportedly immutable transactions. The preference for unidentified and unregulated intermediaries might be explained through the lens of politics. In a book titled The Politics of Bitcoin, David Columbia argues that much of crypto's pro-decentralization rhetoric actually derives from extreme right-wing talking points about the evils of government. The existence of DeFi intermediaries can be more easily reconciled with decentralization rhetoric if DeFi intermediaries are seen as inherently less problematic than other kinds of government and government-sanctioned intermediaries. Still, the fact remains that decentralization is an illusion. And it's important to note that DeFi doesn't really aim to create truly new financial products or services. Instead, it aspires to provide existing financial products and services in a decentralized way. But if intermediaries are added back to that decentralized system, aren't we just left with unnecessarily convoluted and complex ways of providing what's already available? Many software engineers have discussed the inefficiencies that come from decentralization efforts. As I mentioned earlier, these don't scale well because they need to be inherently wasteful to deter bad actors. And so a solution developed from the outset with a centralized intermediary will almost inevitably be simpler and more efficient than anything that relies on a blockchain. Many software engineers have also commented on how unusual it is for a technology to still be pursued after 15 years with no killer app. Turning to the promise of financial inclusion, I think there's no reason to think that these convoluted and complex products will solve the problems faced by underserved consumers. Frankly, forcing consumers to accept more clunky and complex, not to mention unregulated, alternatives because we lack the political will to solve the underlying problem of providing affordable basic financial services. I think this smacks of subprime mortgages and other forms of predatory inclusion. And Tendencies Carmona at the Brookings Institute has just written an excellent piece on this issue. So having made the case that we lose little by clamping down on DeFi, I turn to the mechanics of how that clamping might actually be done. Because negative spillover effects from DeFi will wreak the most havoc on the real economy if regulated banks become integrated into the DeFi ecosystem, the first regulatory step taken should be to wall off DeFi from the established financial system. As a priority, regulated banks should be banned from issuing stablecoins or providing any dApps, holding stablecoin reserves in a deposit account, investing in any DAO, dApp, stablecoin, crypto asset, etc. In terms of further steps, I would say that some of the reluctance to regulate DeFi and crypto more broadly stems from an uncritical acceptance of the decentralization rhetoric. If DeFi were truly decentralized, there would be no intermediaries to regulate. But as I've already discussed, DeFi is rife with intermediaries. Some of them may be beyond the jurisdiction of the US regulators. I'm sorry, I prepared this for a US audience. America-centrism, I'm sorry, but there will be always jurisdiction of regulators from an individual country, but there are many intermediaries that are housed in the United States or other countries that could be accessed with regulation. So in the paper, I propose applying the licensing regime I developed in my book, Driverless Finance, and which was based on previous work by Salia Marova. I propose applying that to DeFi dApps and stablecoins. If those products and services can't or don't obtain a license, then centralized intermediaries should be prohibited from issuing or providing any service in connection with them. Now, this leaves open the possibility that should a truly killer dApp evolve in the future with more to recommend it than purported decentralization, then it could obtain a license. But otherwise, US-based intermediaries will not be able to work with them. This would force DeFi to live up to its claims of being truly decentralized. I want to conclude by saying that I am not an apologist for the existing financial industry. There are real problems of financial inclusion and concentrations of power that require hard work to solve. But I worry that shiny technological solutions trading on potential will distract us from doing that hard work. In a kind of twisted irony, the 2008 crisis created the distrust in the mainstream financial system that allowed something as convoluted as DeFi to have any appeal in the first place. But 2008 also shows us all too clearly the perils in allowing DeFi to evolve unchecked. Financial regulators should act preemptively to prevent DeFi from becoming shadow banking 2.0. So I think I went a little under time there, but I hope that's okay. I like to have more time for Q&As.
At least more time for Q&A. And that was an excellent presentation. I'm also glad that you quoted our common friend and colleague, Saúl Marova, whose research also on fintech has been, a cautionary tale long before, we have suffered some of the if you call it rightly, as it has been called in the press, the winter that we have been experiencing since May this year. So that cautionary tale obviously needs a greater audience. And it's not to say there are many technological innovations which will be good. It's just the kind of the Wild West that we have been living and the absolute lack of regulation of an area where, as you say, the impact, the potential financial stability impact, which is one of the key arguments in your book, is fundamental. So without further ado, because I'm not the discussant, I have my very dear friend and wonderful colleague, one of the experts in these areas. You were saying we cannot have a better discussant than Emilios. So I will mute myself, Emilios, and give the floor to you. Thank you very much for being with us today.
Thank you very much for the invitation, Rosa. I should say that indeed, I am a disciple of Professor Lastra for a long time. I'm much older than her. The first time I attended the London Regulation Seminar must have been 10 years ago. I think I was younger than Daniel. So thanks for the invitation, and it's an honor to be part of the seminar. I much enjoyed reading Hilary Allen's paper, and unsurprisingly, I agree with most of the findings of her paper. Now, I should add, for the sake of dialogue, a couple of thoughts of my own. The first of all is that this industry has serious liquidity problems, meaning contracts, the financing of contracts, first of all, that there are supply and demand liquidity imbalances, and then that the refinancing of contracts, there is no central bank to do that. That means liquidation of collateral and lowering leverage. That liquidation of collateral will result in spillovers, financial stability spillovers for the mainstream institutions. And there is a Financial Stability Board recent paper that discusses that issue. The paper discusses non-bank financial intermediation, but it's mostly focusing on the spillover effects of liquidating collateral. And that goes to the heart of DeFi, of the DeFi industry, because the collateral is impossible to value, especially before we had the crypto winter, we had the collapse of major crypto lending operators like the Celsius network or the Voyager, because it's very hard to put a price to the collateral. The market is extremely volatile. Now, I will come to the issue of financial innovation as well. There is an incredible book by my colleague, a sociologist here in Edinburgh, Donald Mackenzie, who has shown that most of financial innovation in the last 30 years was a rent-seeking attempt by the industry. Now, in the case of decentralized finance, I will say that I have come to the conclusion that the innovation claim is hiding diligently fraud. This is an industry where fraud is very widespread. To give an example, Voyager was presenting its crypto deposits as secured by the Federal Deposit Insurance Corporation, and that resulted in that fraudulent financial promotion resulted in a paper by a joint paper by the FTC and the Federal Reserve Board saying there are not any deposits with them that are not secured, are not insured. So from personal experience, I know that there is somebody who has put in circulation in the industry 2 crypto coins because they are neither currencies nor money, which have the names of 2 very famous mathematicians. Now, the white paper of that crypto coin was saying that the proceeds of the ICO will be used to secure access of children in Africa to education. The proceeds of the ICO have been used for him to buy an Apache helicopter. Now, what he's going to do with an Apache helicopter, what can I tell you? He is probably for the expertise of a different kind of scientist. He also bought a Learjet for himself, which I guess, if you engage in lots of traveling, has its uses. But in any case, the main point is that that's an industry rife with fraud. And that's what shows the different collapse of XTC as well. Fraud results in from the multiple uses of collateral, which makes the industry also highly collateralized. Now, why I agree with Hillary Allen. Who can forget that seminal paper by Gotton and Meklik, The Run on the Repo, explaining the last crisis as an issue of refinancing the then illiquid shadow banking market, which brought down Lehman Brothers. It was not bad lending that brought down Lehman Brothers. It was bad lending what brought down German banks or Irish banks or Spanish banks. Lehman Brothers came down because of bad innovation. What does that mean? The paper became illiquid and the bank could not refinance its positions in the shadow banking markets. So refinancing is very important in this context, especially because the collateral could become illiquid and impossible to price. Now, this industry does not only issue crypto coins, it also issues the so-called non-fungible tokens, which are impossible to price. Why there is a market for these instruments, which at the most, and if we follow my analysis to its logical conclusion, is that they are pyramids. Well, there is a market because you need to focus on the most frequent users of these crypto coins or investors. If you take the findings of a recent BIS paper on Bitcoin, it says that the average investor user is a white male addicted to high risk. Now, if you have basic knowledge of Dostoevsky's output, there is a novel called The Gambler. So a specific type of white male is risk-taking and like people who gamble with their money. The idea, I do not claim the paternity of the idea. Recently, Professor Lastra organized an exceptional seminar at the Bank of England under Chatham House rules. I will not mention names. A leading British regulator said, how can we protect investors from themselves? He also said that's not the job of central banks. I might not fully agree with that statement. He said they should be within the remit of the Gambling Commission, of the Games and Gambling Commission. That brings me to the question, how do we regulate something so exotic and, if you will, strange and weird and unusual? There are two lines of inquiry. Should they be subjected to prudential regulation, initial capital, liquidity reserves, and so on? Crypto lenders, my view is yes. Crypto lenders do not differ from mainstream banks. I have recently drafted a paper with Alexander Saretakis from Trinity College Dublin, where we present that exact argument, that crypto lenders should be classified as regulated banks under EU law. The other line of inquiry is investor protection. Lots of the white papers are full of fraudulent misstatements. So, especially in the United States, where crypto assets are regarded as investments or securities, I would think the misstatements in the ICOs constitute securities fraud. And those who facilitate the dissemination of crypto assets on the basis of fraudulent white papers should be arrested for aiding and abetting securities fraud. I know that I sound too severe for something that allegedly is the promised land because of innovation. On the other hand, it's an industry that I have, like Hillary, I have examined very closely. And if you look at the BIS paper that I have just mentioned, most people who invested in the holy grail of crypto markets, Bitcoin, have lost money. And when do they invest? Because the market is very volatile, and when there is a spike in the price of Bitcoin, there is a massive change in demand liquidity. That means new buyers. So all these people have lost lots of money. Who can protect investors from themselves in that context? Well, that's the jobs of securities regulation. There is speculation in securities markets as well. I'm not talking about making speculation illegal. That would be illogical in a liberal markets environment, in a free markets environment. So the type of regulation I would suggest for most crypto issuers is pursuing the securities fraud revenue. And for the institutions themselves, prudential regulation. Why? Because capital and liquidity requirements would stabilize the market and they would make the DeFi participants more stable and less of a source of risk for the market or systemic risk for the financial system. And I fully agree with Hilary Allen's suggestion that these assets should be segregated. The problem right now is we do not know what should be the capital charge for a bank that holds crypto assets. The BIS Innovation Hub is still working on how to create granularity for risk in crypto assets. They have not produced a final paper yet, but they are in the process. However, whichever way you look at it, this is a global problem. It's a global problem because millions of investors have lost their money. It's also a global problem because decentralization, as Hilary suggested, is a misnomer. Crypto lenders, for instance, are traditional intermediaries. And on the basis of recent evidence, crypto exchanges should be doing nothing apart from facilitating trading between investors, which access the crypto exchanges through internet, through applications that are available on the internet or their smartphones. Clearly, crypto exchanges act as market makers. Why they act as market makers? Because they can reuse the collateral that investors or users post with the exchange. That looks to me like the rehypothecation done by lots of intermediaries in the shadow banking sector. Of course, the US regulators have prohibited rehypothecation. So there should be some form of regulatory intervention in the field of collateral, and not how much collateral should crypto lenders or crypto exchanges require, but mostly prohibiting them from using investor or client collateral. Why? Because that multiplies leverage and amplifies the risk of bankruptcies or the impact of bankruptcies in that sector. And the impact is inevitable because there are going to be margin calls as they liquidate their holdings of crypto coins, having already used them as collateral. Then if there are margin calls, and there are bound to be margin calls, they will liquidate their holdings in so-called safe assets. So they will create fire sales in safe asset markets. And that's how liquidity risks transport themselves from one market segment to another market sector. On this basis, I want to congratulate Hilary. I did not have lots of critical remarks, but that happens sometimes. A discussion is not necessarily a prosecutor. Sometimes the purpose of having somebody to give a comment is to be supportive or complementary.
In this case, it really strengthens the arguments that Hilary has made. And I think it's important because I think, the two of you in your writings, you have warned about some of the dangers in the industry a long time ago and some of the recent events just have shown how much foresight you both had with some of the predictions that you elaborated in your papers and in your research. Before I give the floor to the audience, and the first question is going to be coming from Daniel Dalba. Hilary, do you have any reaction to the discussion that Emilios just presented, and if so, just feel free to just answer directly before I give the floor to Daniel and then the rest of the audience.
Great. Yes. Well, first of all, thank you, Emilios. I think in many respects, we are in violent agreement, as they say. So I particularly appreciate that you situated my paper in the broader context. So yes, this is an industry that is absolutely rife with fraud. I think it is accurately described, not in a pejorative sense, but in a descriptive sense, as a Ponzi scheme, because these are assets that only derive their value from someone else being willing to purchase them, because they have no sort of underlying productive capacity tied to them. So it's really important to have that context, and I don't get into it in this paper, because in many ways in this paper, this is sort of taking DeFi on its own terms and saying, what the problem is. And so I wanted to sort of show that not only is there all kinds of bad behavior, but even if it works without the bad behavior, it's still fundamentally flawed. But I really appreciate you contextualizing all of that for this conversation. I also appreciate your contextualizing this in the in this idea of gambling. People sometimes ask me, like, well, why do people buy this stuff? I'm like, I think because they're gambling. And there's some really interesting sociological research that I've only dipped my toe into about sort of social precarity and gambling. So in times of significant uncertainty. So apparently it happened a lot during the French Revolution, American Revolution, when there's a lot of uncertainty about what's going on, that people sort of want to have those Hail Mary attempts to gain some economic security. And I suspect with all, and this is really armchair psychology from me, but I suspect with, the specter of climate change and the world order changing, et cetera, I think people are nervous. And so they want to make these Hail Mary gambling attempts to try and shore up their economic security. And I think that's part of what's going on. In terms of sort of crypto as gambling, in the last week or so, Todd Baker published a great piece on the Columbia Blue Sky blog saying that this really is all gambling. And he said that as a result, financial regulation shouldn't touch it. And that's a really provocative and interesting position. And I don't agree with him all the way, but I agree with him halfway. So this comes to the only point that I disagree with Emilios on, which is the prudential regulation of crypto lenders. So this is a debate that I have with many of my financial regulatory colleagues. There are two camps. There are the people who say, this is doing bank-like stuff, let's regulate it like a bank. And then I am in the camp of, if we regulate this like a bank, we run the risk of treating it or making it essentially too big to fail, of giving it access to all kinds of government subsidies in the form of lender of last resort, in the form of sort of overdraft protection for payments, all of those things. And the reason why we afford all those subsidies to banking is because banking, there's a quid pro quo. Banking actually funds or makes loans and provides payment services that are necessary for broader economic growth. And my sense is that crypto does none of those things. And so we shouldn't be giving any benefit of government subsidies to it. So I want to take those crypto lending models, and I want to treat them as securities, because that's why people are really buying. Like, the crypto lending, they're saying, stake your securities to get a yield. To my mind, that is a type of securities investment. And so I'm very much in agreement with Emilios that we need much more aggressive enforcement of existing securities regulation. And in fact, as a preview of my testimony on Wednesday, that is what I'm going to be calling for. So I'm not all the way with Todd Baker on like, or Steve Cicchetti on like let it burn. As much as I sort of see the appeal in those arguments, I think people are being harmed. I think they are being duped and defrauded. And so I think investor protection regulation needs to be applied much more aggressively. But I'm very nervous about bringing this into anything that looks like a banking regulatory regime. And then just as one aside, I think the Emilius's points about the liquidity issues in this space are really important. And just as sort of an anecdote, so FTX had a proposal, so FTX that just failed, had a proposal before the CFTC where they were asking to do, and I'm going to get this, it's a mouthful, they wanted to do automated, non-intermediated clearing of products for margined trading for retail investors. But basically, so the idea was that they would take out, brokers or anyone who could exercise any discretion and rely entirely on computer software that would liquidate people. And this liquidation could happen 24/7, right? So while you were sleeping, you could be liquidated and all of your assets could be dumped. So from an investor protection angle, that's terrible. But the thing that concerned me the most is the thing that Emilius identified, which is the fire sales. What happens, it's not like it's going to be idiosyncratic that someone's portfolio is being liquidated. It's going to be everybody at the same time. And then, what does that do to the prices of assets elsewhere? And I raised this at this roundtable at the CFTC had with Sam Bankman-Fried sitting at the table with me, and his he live tweeted the whole roundtable for one, which I thought was reasonably juvenile. But his reaction to this was, what is she even talking about? She's talking about so many different things interacting. And I was like, yeah, that's how this works. So fortunately, that proposal has been abandoned because of FTX's failure. So that's good news. But the broader issue about the liquidity consequences of dumping these assets en masse through automated liquidation remains a very strong concern.
Thank you very much, Hilary. Let me now move on to the question and answers turn of this session. And the first question comes from Daniel. Daniel, if you want to ask the question.
Yes, yes, for sure. Thank you very much for the presentation. Very interesting. Also, the arguments until now. My question is a little bit philosophical, but also a question for the future. So essentially, we have seen that we are living in a crypto winter. So if we look at summer 2022, we had the collapse of Terra and the associated then token of Luna. Then continuing, we have a lot of collapses from Celsius Network, that was an experimental cryptocurrency bank, until the collapse of crypto exchange FTX. Essentially, what I saw in this kind of saga is that the real world has not been attacked by financial instability. So if there is financial instability, it's something that was located towards this digital world. So my question, in fact, was this, essentially, if we are going then to regulate and to extend regulation to this decentralized finance, are we sure that in reality we are not creating the next type of connection that there will be between the real world and the digital world? And also we are speaking about two different worlds, because if you think about traditional banking, we go in suit. If you speak about FTX and so on, they go into shorts. So do they deserve also this kind of regulation as important as banks?
So it's a great, oh, sorry. It's a wonderful question, and sort of one that I started alluding to in why I think that the banking regulation should not be applied to this crypto space, but it should be applied very strongly to keep the banks out of this space. So the reason I think that we haven't seen contagion from the implosion of crypto into the broader financial system is not that it's small. The subprime mortgage market wasn't that big either, but its tentacles were sort of spread through the banking system. And so it was able to cause a global financial crisis. Why we haven't seen that is because there isn't this integration between banking and crypto, and that's not an accident. Banks are interested in this space and have been trying to get into this space, at least in the United States. And fortunately, the banking regulators have held pretty firm on not allowing that to happen. So I think that's the good news. And so what we need is for that status quo to persist and be strengthened. So that, because we are seeing, so for example, JP Morgan just did a trade on a permissionless blockchain. Bank of New York Mellon has been authorized to do custody of crypto assets. So we're starting to see that integration, and so this is a place for banking regulators to really put their foot down and say stay out. And then I think we're in a good spot. I don't think that, but this is the big debate. I don't think that investor protection regulation brings crypto closer to the core of the financial system and makes it likely to be bailed out. I think investor protection regulation can sort of protect investors whilst not endorsing crypto, but I think banking regulation endorses crypto and brings it closer to the financial system.
Thank you very much. I think Emilios wanted to add something. Emilios?
Yes, just as an aside or footnote, somebody wrote in the Financial Times recently, and I agree, the demand for Bitcoin shows the global demand for money laundering. So the other reason that you need regulation is lots of activity in the crypto markets is a criminal activity. And I know a crypto coin that is tailor-made for the wishes of the Japanese mafia. I have not said that.
And we haven't even gotten into the environmental costs of all of this as well. So
exactly. So there are good reasons to regulate. Perhaps on the prudential angle, you can, because there are moral hazard problems, you can exclude them from deposit insurance. Deposit insurance does not have to apply to all banking institutions, and of course, from lender of last resort, if it's possible. Because otherwise you use public subsidies to boost speculation. It has been suggested by one of our colleagues from Duke University also that there should be a lender of last resort for shadow banking. And my comment to that paper was that that would be a very good way to fund speculation and boost speculation.
Yeah.
So yes, I share the moral hazard argument and reservation, but that does not apply, I agree with you, Hilary, does not apply to investor protection regulation or regulation that stops the anonymity in those markets. Of course, if you stop the anonymity, demand will collapse because lots of the demand comes from criminal syndicates, or it finances terrorism, or the market is used to evade the recent sanctions on Russia and so on.
Yeah, we have one more question. It is actually a very interesting debate that we are now reaching, which is once that we decide that this needs regulation, and that's one of the key points of your argumentation going from shadow banking 1.0 to shadow banking 2.0, is what type of regulation? You have mentioned environmental cost, Emilios mentioned fraud, we have referred to banking, we have referred to securities. There is also this gambling. There is also this idea of protecting people from themselves, giving warnings like tobacco manufacturing. So it is a very big question, the environmental cost. So it's not just that it is an area that has been unregulated so far, and that now is in need of regulation. The debate now is what type of regulation, and I think it's a very, very interesting debate, and I will be very the Senate on Wednesday, because I think that is that's one of the key things forward. Once that we get more fine tuning into the debate of how to regulate the sector that so far has been unregulated. There is also investor protection, consumer protection, insolvency rules. It's all the traditional classic legal apparatus, plus all the other regulatory concerns, given information, given increasing, given the public interest at stake. So it's a very interesting debate. In that light, we have a question here from Giulio Ronzino, and is directed to Professor Hilary Allen. We all then come to the same conclusion. Cryptos are very risky and need to be strictly regulated quickly. That said, can we extract any good from this world? And I think it's a very fitting question to provide a finale to this interesting discussion that we're having to see what are the opportunities. Always in finance, particularly with innovation, there are risks, but there are also opportunities. Somewhere in everything that we're seeing, there are also the opportunities that innovation can bring. So what is the good? What are the opportunities, Hilary?
So it's a very good question, and very good one to end on. And so I've written about fintech more broadly. And with it's a harder cost benefit calculus, right? There are risks, but there are also potential improvements that I think could be really useful. Blockchain technology, I think, is bad. The more I talk to technologists, this is, and that's a large part of what I tried to do in this paper, is to explain that this is not technology that is helpful. So, I think it's become sort of de rigueur to say, well, crypto is bad, but, the blockchain technology might have some uses. And I don't think that's the case. I think blockchain is operationally clunky, et cetera. So I think this is a technology to jettison, frankly. So then if we're throwing out the tech, what is there any good to come of this? And I will say that there is one thing that I think crypto marketing has done very well. And that is to diagnose problems in our existing financial system and bring them to the attention of the public. I don't think it solves any of those problems. I think it makes them worse, if anything. But really, bringing the need to improve financial inclusion to the fore, bringing the need for faster payments to the fore, bringing the fact, drawing people's attention to the mess that is cross-border payments, right? All of this, I think, is useful and could, if we, as I said, put in the hard work of solving those things, could make the existing financial system much better. But I don't think crypto has the answers to that.
Thank you very much, Hilary. Both Emilios and myself have one of our maestros, Charles Goodhart. And Charles Goodhart wrote in 1988 his famous book on central banking, The Evolution of Central Banks. And one interesting argument he said is because also before we had central banks, we had a system which was decentralized. And he says that there is a natural tendency in financial markets to gravitate to some center, to some clearing. And that, he claimed, was at the origin of central banking, combined with the argument of moving from a profit maximization to a non-competitive, non-profit maximizing institution. So that's an interesting argument that when I read you quoting, from the BIS, the illusion of decentralization, it came to me, this natural tendency to gravitate to the center, which is at the core of why financial markets need protection. And that protection, obviously, is the big justification for regulation. So we have one more question, and with that, we will finish. And so if I read the question, this is from Elias Ioannou. Traditionally, regulators and legislators tend to regulate behaviors and not technologies. Would you suggest moving from this approach to a more technology-specific regulation for blockchain, given that last statement you made?
So it's a really hard thing to do. I mean, this actually translates well into the sort of institutions versus activities regulation. Like, in theory, we often would want to regulate activities, but it can be challenging to do. So we tend to default to regulating intermediaries who engage in the activities or who use the technologies. And I think because crypto does have so many intermediaries, that's probably sort of the path forward here, rather than trying to regulate the technology per se. But I will say that I think as, and this is a broader point, as finance is incorporating all kinds of new technologies, I think it is critical that financial regulators start to develop capacities in these different kinds of technology, especially when it comes to operational risks, right? So if the financial regulators don't understand how financial services are being delivered, then we've got a problem. So I'm not sure if we sort of try to ban a technology. I don't think that works, but we need to understand the technologies in order to regulate, because, you know, finance is a technology business now. And so if we only have lawyers, economists, and accountants in the financial regulatory agencies, are going to miss a lot of the risks.
I think that's really an excellent point, and actually very fitting, because for this seminar is an intercollegiate, interdisciplinary group of experts. And your last point makes me realize that we need also more technology experts. We have traditionally relied on, you know, lawyers, economists, political scientists, but clearly the interaction between law and technology is fundamental. And given that we have many students listening to us, that's a combination that maybe some of them, some of you can take on. There is in the chat, and with that I will finish. Thank you for your reply. Congratulations for a great presentation. And Hilary and Emilios, this was really a brief, concise, but excellent discussion of one of the most lively issues for debate that we have in the last part of the year 2022, and one that is likely to continue into 2023. So let us know how your submission to Parliament again goes. And we give you thanks in the customary way, which is clapping, but, you know, we'll have to put the emojis. I will do it, you know, with my hands. And again, thank you very much, Emilios. And I look forward to seeing more of your research very soon. Thank you, everyone, for joining.